Jeff Bezos's financial empire. Jeff Bezos's financial empire rests on a rigorous and singular philosophy: the cult of the long term, the maximization of free cash flow, and aggressive diversification through the liquidation of his historical assets. With a personal fortune currently hovering around $224 to $275 billion according to Forbes' real-time billionaires ranking, his financial journey breaks down into several major strategic choices. Financial philosophy at D. E. Shaw & Co. In the 1990s, within the quantitative fund D. E. Shaw & Co., Jeff Bezos mastered financial arbitrage and mass data analysis. It was there that he understood the asymmetric value of risk, designing a project where potential losses are limited, the starting capital, but where theoretical gains are infinite. When he observed the growth of internet usage, he applied a mathematical framework he calls the regret minimization framework. From a purely financial standpoint, this model rationalizes giving up a very high Wall Street bonus for an uncertain but highly leveraged asset. Amazon's capital structure, 1994 to 1997. Amazon's first funding round is a lesson in startup financial engineering. Initial valuation: in 1995, Bezos valued his young company at $6 million, an arbitrary figure designed to attract angel investors while avoiding too rapid a dilution of his own shares. The angel bet. The 22 original investors injected a total of $1.2 million. Those who held onto all of their original shares saw their $50,000 investment turn into several $billion over the decades. The dot-com bubble pivot: just before the dot-com crash in 2000, Bezos pulled off a masterful financial move. Amazon raised $2 billion in convertible bonds from European investors. This massive cash reserve allowed Amazon to survive the stock market collapse, while its direct competitors, starved of liquidity, went bankrupt. The free cash flow revolution. For more than 20 years, Amazon posted net profits close to zero, drawing repeated criticism from Wall Street. However, Bezos' strategy did not target traditional accounting profit, earnings per share, but rather the maximization of free cash flow. In his famous 1997 letter to shareholders, he explained that a company can show profits while destroying value if it must reinvest more than it earns just to sustain its operations. Amazon optimized its working capital requirement through a negative operating cycle. The company collects money from customers instantly, but pays its suppliers several weeks later. This permanent floating cash finances aggressive expansion, logistics centers, AWS servers, without resorting to massive debt. The 2019 divorce financial turning point. In 2019, the divorce of Jeff and Mackenzie Scott redefined Amazon's shareholder structure and became the most expensive divorce settlement in financial history. Jeff Bezos transferred 4% of Amazon's outstanding shares to Mackenzie Scott, a stake valued at the time at approximately $36 to $38 billion. Control protection. To avoid destabilizing Amazon's governance, the agreement stipulated that Jeff Bezos retained all voting rights associated with the shares transferred to his ex-wife. This allowed him to remain the undisputed leader of the company without fear of activist investors, despite the division of his fortune. Massive liquidations and reinvestments. Since stepping down as CEO in 2021 to become executive chairman, the management of his fortune resembles that of a sovereign venture capital fund. Financing method: programmed sale of approximately $1 to $2 billion in Amazon shares each year. Total capital injected by Bezos amounts to nearly $28 billion. Financial goal and impact: finance the heavy infrastructure of the space economy, including the New Glenn rocket and the NASA lunar lander. In May 2026, management mentioned for the first time the possibility of opening up to outside investors to face growing competition from SpaceX. Project Prometheus. Financing method: ongoing fundraising amounting to tens of billions of dollars. Financial goal and impact: an AI startup focused on engineering and industrial production, marking Bezos' first operational role as co-CEO since his departure from Amazon. The Washington Post. Financing method: direct personal acquisition for $250 million in 2013. Financial goal and impact: media and influence diversification. The company is currently undergoing a major financial restructuring under his direct oversight. Bezos Earth Fund. Financing method: philanthropic endowment of $10 billion committed by 2030. Financial goal and impact: direct grants for climate transition initiatives, while also serving as a tax optimization vehicle for his massive capital gains. Angel investments. Financing method. Direct equity stakes taken via his personal fund, Bezos Expeditions. Financial goal and impact. He was one of Google's very first investors in 1998, injecting $250,000. That block of shares would be worth tens of billions of dollars today had he retained it in full. From a garage in Seattle to the edges of space, every dollar Bezos spent was a calculated bet on the future. The real lesson? The greatest investment he ever made was simply refusing to think small. If this breakdown gave you a new perspective, drop a comment below, and don't forget to subscribe for more deep dives into the world's. Thank you.